Hi, welcome back. Now we're going to start talking about control risks and how we test for those. Alright, so as you know, we're auditors. We want to keep audit risk very, very low. Last video we talked about inherent risk, right? And what could go wrong in the revenue and collection cycle. Now we're going to talk about control risk. Now control risk rests at the client, right? All we can do is test for it. So, as auditors, we understand the inherent risks in the revenue and collection cycle. Oh, people are going to want to recognize revenue early. Oh, people are going to want to overstate accounts receivable. All right, so we know what our clients might do. So we know what our clients should have in place to control for those misstatements, right? And so now we're going to check for those controls. And we're going to test for them and see if they're working effectively or not. Then that'll give us an idea of the risk of material misstatement, right? So next part, looking for those controls at the client, figuring out what controls are there. Do I think those controls will work? And if they're in place and I think they'll work, I'm going to test them, right? No point in testing controls that I don't think work. All right, so key controls in this part of the cycle, certainly separation of duties. A salesperson should not be able to approve credit. A person with accounting authority should not be able to make authorizations for like write-offs, things like that, separating accounting, authorization, control, right? So there should certainly be separation of duties. I always think of it as CAR, custody, authorizing, and recording. The recording being the accounting part. CAR, custody of an asset. So if you're in charge of accounts receivable, that's an asset. You shouldn't have the authorization to write it off. Why? Because then you could fake a sale and put a fake receivable on there and then just write it off, right? Make it disappear. So you get credit for the sale, but nobody ever has to pay for that sale, right? So CAR, custody, authorizing, and recording, all separate. Important for almost every part of every cycle, segregation of duties. Authorization, so different parts of this cycle need somebody to authorize things. Write-offs of accounts receivable, big one. Not just anybody should be able to make that decision, and certainly the people who do the accounting shouldn't be able to authorize it. So there should be documents where a credit manager authorizes good credit. There should be documents where a collection manager authorizes a write-off, things like that. There should be authorizations for electronic transactions, right? So if everybody's using SAP and Walmart orders Tide from Procter & Gamble, is there an electronic authorization built in the system that says, yes, this is really Walmart, yes, it's really authorized, yes, they have credit, things like that. Pricing, one way to cheat is to change your prices. You can authorize discounts for your friend, right? So a lot of this will involve some other kind of fraud, but imagine if you have the authorization to give a discount, right? So that could create revenue recognition issues. Certainly access to assets like the inventory, right? You have to make sure that there are controls keeping the inventory from walking out the door. And certainly you have to have controls like a lockbox account to keep the account receivables from being stolen, right? So if account receivables are being paid by checks, somebody may want to steal that. Records. So having anything pre-numbered is going to go towards completeness. Just kind of memorize that. When you see a control pre-numbering, it's trying to make things are complete. Why? Well, because if an invoice is missing, if they're all pre-numbered, if you see invoice 1, 2, 3, 6, 7, 8, you know, oh, invoice 5 is missing. It's not complete, right? And remittance advice, that helps keep, that's where, if your client has accounts receivables and they send out invoices, in theory, when the check comes in from those customers of your client, the customers of the client are going to send like the bottom part of the invoice or something like that. That's what we call a remittance invoice, and that can be used to post the accounting transaction. So that way you can keep the asset, the check, which is the asset cash, the check separate from the person doing the accounting, right? So the accounting, so remittance advice might be as simple as a list of what the accountants need to post. So the person who has the checks makes a list, they give that remittance advice to the accountants who post it. So you got segregation of duties. And of course independent checks, right? So some entity out there or some part of the system is resolving and balancing and making sure that the financial statements are going to have the right numbers. So you've got things like accounts receivable subledgers. You would never post a payment or debit an account receivable account to the what we call the control account, right? So when you look at the balance sheet, you see one line, right? It says accounts receivable $5 million. Well, that's the balance of the control account, right? Actually, when you're posting separate transactions, you post them to what's called a sub-ledger, right? So if I had an account at Dillard's and I went and bought something at Dillard's, they would post that, they would debit that account receivable, that's an account receivable to Dillard's when I go buy something and pay for it at the end of the month. Dillard's would recognize that revenue and put down that account receivable, but they would post it to my subledger, right? So they know Scalin owes this much. And if you total up all the subledgers, then that totals what we call the control account, the GL account, the general ledger accounts receivable. So you balance those. So all your subledgers added up should total the account receivable general ledger. And of course, sending a statement out is a control, because you know what? If a statement goes out to a customer and it says they owe more than they do, they're going to call somebody. So that's a great check. All right. So these controls should be in place. All right. So controls should be related to assertions. Right? So a control for the assertion occurrence. Right? So what can go wrong? Well, they can overstate sales. What control activities are in place? Well, there should be an invoice that has a customer purchase order, right? If the customer didn't really order it, that's a fake sale. So we should be able to see that purchase order. We should be able to see shipping documents exist. So it was a real sale. There's a bill of lading where we shipped it, right? So you can test for completeness by making sure the invoices are in numerical order and they're all there. You can check for cutoff by looking at the shipping document and seeing what date it was shipped. So is that sales date match the shipping date, right? Same thing for accounts receivable, right? You can check those documents. So I'll let you read through all of this or read your book on what control activities relate to which assertion, but that's how we're thinking about our control activities, right? So when I think about controls, I think, okay, is there a control in place for occurrence? Or several, right? There's obviously more than one. Are there controls in place for occurrence? Look for those. Yes. Are there controls in place for completeness? Look for those. Yes. Are there controls in place for cutoff? Look for those. Valuation. Look for those. Right? So I'm thinking, as an auditor, I'm thinking about what controls should be in place for each assertion. Are they there? Right? I look for that. Now, once I test it, once I understand what controls are in place at my client, right? So now I know, okay, they are matching the purchase order to the invoice before they book the revenue, or the shipping document before they book the revenue. So now I know they're doing that. So I can now go test that. So I have to think, okay, how can I test that? Well, if I'm looking to make sure that they have all the documents, right? They have a customer purchase order, then they ship it, so there's a bill of lading, then they send an invoice, so there's an invoice, and I use that invoice to record the transaction. Well, I can go vouch, right? So vouching is the audit technique used to test for what we call occurrence or overstatement, right? So vouch for occurrence or overstatement. And vouching simply means that I'm going to take a sample of whatever I'm vouching. Let's say it's sales data. So I'm going to vouch that sales data. So I start with the sales ledger and I go back. I say, okay, if this is really a sale, there should be an invoice. Oh yes, there's an invoice. Well, if this was a legitimate sale, there should be a shipping document like a bill of lading. Oh yes, there's a shipping document. They did actually ship this. Well, if this was a legitimate sale, they didn't just ship it out to somebody, there should be a customer purchase order, right? So I'm going back, I'm starting at the ledger, I'm selecting, they're saying this is a real sale. Is it really a real sale? And I go back through the documents to make sure that was an actual sale, that it really occurred, right? Completeness means I'm testing to make sure that all the sales that truly occurred got in the books, right? Nothing got left out. So what controls should be in place for that? Well, there's that pre-numbering of things like invoices, right? So as an auditor, I should be able to scan those documents and look and see, oh, invoice number 5 is missing, so this must not be complete, right? I can also trace. So I could start with, okay, here's a customer purchase request. This customer wanted to buy this. Well, so is there a shipping document? Oh, yes, there's a shipping document. We shipped it. There's an invoice. Oh, yes, there's an invoice. Did this invoice get in the books? Oh, this invoice is not in the books. Okay, so that's incomplete, right? Again, not as big a problem for sales, but could happen. And the same idea applies to receivables, right? You have to think of a test. Once you understand what's the risk, right? So what controls should my client have in place? What can I test for? So the same idea. I can vouch or I can trace, right? Vouch, trace. I can go look at the books and see that they exist. Inspect documents, make sure that they're all there. Valuation, I can test and see that they have a method for calculating the allowance and they follow it. Something like that, right? If something's an estimate, understand what the controls are for how it gets estimated, right? Oh, there's a person in the accounting department who follows these rules, and then the estimate ends up being this. So these are the tests. So here's a little reminder of the directionality of testing. So you need to understand the difference between what we call vouching and tracing, right? So when you're an auditor, there's kind of 2 different places you can start your test. You can start your test with the book, so you could go to you could go to the journal entries or the ledger, the subledger accounts, and you could say, okay, here's these sales that are on the books, right? These are sales they're saying occurred. They're on the books. Get it from the ledger, get it from the journal. So, did they really occur? How am I going to figure that out? Well, I'm going to do what auditors call vouch, right? I'm going to go back and look at the documents, right? So see how start with the sales journal, go back, right? So if I want to see if something really occurred, I could pull a sample of things that they're saying occurred and go back and look at those bills of lading to see did they really ship. Go back and look at the invoices to see did they really bill. Go back and look at the customer purchase order. Was it really ordered by the customer? So I can go back, right? That's called vouching. Vouching for occurrence or overstatement. Because if they're not real, then the account's overstated. All right, so I vouch for overstatement. Another thing that could happen, like I said, doesn't happen too much with sales, but could if they have a bad accounting system, could be understatement. Not all their sales got on the books, right? So now I need to do what's called tracing, right? And again, my starting point now is with the documents, right? So in other words, a real sale really occurred, but I'm worried it didn't get in the books, right? So I go back to where a sale would start. Could be with the shipping documents, could be with an invoice, could be with a customer purchase order. But I start with where the sale would start if it was a legit sale. So I find a sample of, oh, here's a bunch of bills of lading. These were actually shipped. I can tell because I got the bill of lading here in my hands. So then I go, well, if this actually shipped, it should be a sale, should be account receivable. Let me trace that to make sure it got on the books. So that's what we call tracing. So you trace for understatement or trace for completeness or understatement, TCU, trace for completeness or understatement. All right, so that's the directionality of testing. So as an auditor, it's important to understand where you start with taking your sample leads to whether or not you tested what you thought you were testing, right? Okay, so that's the directionality of testing. You take your sample from the books and go back. You're doing what's called vouching. You're testing for occurrence. You take your sample from the transaction documents and trace to the books. Now you're doing what's called tracing and you're testing for completeness. All right. Few other control tests you might want to do. Completeness, pretty limited testing, but you'll check that. Accuracy of revenue and accounts receivable, is that number right? So in other words, accuracy goes towards like just did they do the math right? Did they use the right price? You would check the price list. You might check an invoice and see, okay, how are they calculating this, right? Do they have a method for making sure that the price is right? Do they have a method for doing the extensions on the invoice and footing the bottom? Cutoff, is it in the right period? Classification of accounts receivable. So classification means, is it actually the account they're saying it is? Is it an asset?